I want to thank everybody for joining us this afternoon to talk about property tax deductions. As we get started, I'm going to just kind of go over our normal disclaimer statement, just reminding everybody that both our presentations and guidance memoranda are never meant to be a substitute for the law. Sometimes there are a lot of very fact-specific patterns, and the code can be very instructive for those. We're going to try to go over a variety of deductions today at a high level. If anything is unclear or you have additional questions, always feel free to reach out to our office and send those questions in, and we'll do our best to try to get back to you with an answer to your questions. As Jenny mentioned, there will be an FAQ that is going to be forthcoming after today's webinar is done. Even if there are a few questions that you aren't able to send in the chat box, you're also welcome to just send those in an email, and we can try to compile those as a part of the FAQ as well. So for today's agenda, we're going to go over just some basics about the property tax deductions, as well as some general overview points for the deductions that are listed. And so starting off with the deduction basics. So starting out with the base question of what is a deduction? And deduction is actually defined under Indiana Code 6-1.1-1-5. And it describes a deduction to be a situation where a taxpayer is permitted to subtract a fixed dollar amount from the assessed value of the property. Now, it doesn't mean that the value overall of the property goes down. It's just a benefit to the taxpayer to slightly lessen the overall amount of the assessed value that will be subject to being applied the tax rate for each taxing district. So the value doesn't change, it's just that benefit. And this is in contrast to a property tax exemption. And that's a situation where a type of property or use of property or ownership in some situations have been determined to not be subject to property taxation. So one is a reduction in the overall amount of value that will be applied to a tax rate. And the other one is the determination that it's just not taxable. And so for each year that a deduction from an assessed value of a property is allowed, the assessed value remaining after that deduction amount is going to be the basis for taxation. And so we refer to that commonly as overall value of your property as it's assessed by the assessor is your gross assessed value, and the amount of the value remaining after deductions have been applied would be your net assessed value. And so the next slide goes over just an example calculation of a property as shown in the formula at the top. The property at issue for the example is $200,000 in assessed value. They have both a homestead deduction and a supplemental homestead deduction. And so you remove the homestead deduction first, and that takes you to $152,000, and you take that remaining amount times by the percentage. In statute for this calculation, we used the 37.5% just based on where we are right now. There was a modification to the amounts for the supplemental homestead deduction calculation for a 2-year period, and those will revert. We'll go over those later in a later slide. But then we also recommend that for this person, they had one of the disabled veterans deductions, and it's recommended that that be calculated as the last one that is calculated from the value. And that's because not only is it a deduction where if you don't have any assessed value to apply that deduction to, because as a later bullet point says, it is possible for deductions to zero out a tax bill. There are options for the deduction with regard to the veterans deductions that can be applied to their excise tax credit. And not only is this just a good, taxpayer-friendly approach to how you would apply deductions, it's also in line with a statutory provision that was added during the 2019 legislative session under Indiana Code 6-1.1-31.5-2.5. It actually specifies that deductions must be applied to property in a manner that will allow the taxpayer to have the maximum benefit of the property tax incentives. And so in this case, because there are other means that they could use any remaining amount from the deduction, you would want to apply that last. And so for any deduction application, they have to be filled out and signed and postmarked by January 15th of the year in which they will apply. So looking at the two, deduction versus exemption, a lot of times the terms are used interchangeably, but they aren't the same. They're very different. But the similarities make it reasonable or understandable why these terms are occasionally incorrectly used interchangeably. In both of the case of a deduction and an exemption, the government is foregoing a certain amount of revenue and really kind of operating as an expense or a loss of revenue to the local unit. It provides property tax relief to owners, and it's going to have an overall impact of shifting the tax burden to other taxpayers. But the differences are really what is important. In first part, for procedural differences, deductions are filed and approved by the county auditor, whereas exemptions are filed with the county assessor and approved by the county PDBOA. So it's important to know the distinction between the two because taxpayers will be reaching out to two separately elected officials for very different tax incentives. And so knowing which way to direct their questions is important. And so it's important to know when something is a deduction and when it's an exemption. So for both deductions and exemptions, but looking at deductions, the idea and the policy that's behind the concept of the deduction is geared to provide some kind of relief to a certain class of taxpayers or a certain type of property owner that, as a policy, General Assembly has determined should have a lesser burden or a reduced burden of what the valuation will be used to calculate their tax bill. This could be, homeowners, which is, I think, the reason behind the homestead deduction, or property owners that have certain improvements that are unique or different in a way that the assessed value shouldn't be altered in some form or another, but maybe having the amount of that assessed value of that property type lessened for purposes of what they base the tax on. Whereas exemptions are geared towards different incentivizing aspects. Some could be needs or services in a community, especially if it's a service type that has typically or would normally be covered by a government body. And so if a non-for-profit, for instance, or a library or a nonprofit utility is able to provide a government function, it's incentivizing the services that are being provided by that entity in lieu of the government providing them. It's also sometimes meant to incentivize economic activity. Could be property that's located within an economic development area or located within an innovation development district. And so that's just a different tool in the toolbox for local units to use to establish different means and mechanisms to try to increase growth and economic activity. And so exemptions oftentimes are partnered with that. But ultimately, the bottom line is that deductions are not exemptions and exemptions are not deductions. They are very different, and they come into play at different points in calculating someone's overall tax liability. So before I turn it over to Dave, we'll just I'll gloss over that there are two broad categories of deductions that we look at. One, we kind of group them based on the characteristics of a property. What about this property would make it subject to a deduction, whether it's because of its use by the individual or because of a specific piece of equipment, whereas some of the other deductions are based on the characteristic of a taxpayer. That could be a disability status or medical status, an age, or professional service, as with veterans. And so sometimes it's important to keep in mind of whether the deduction is tied to the person or it's tied to the property. And with that, I'll go ahead and turn it over to Dave.
Okay, so the first deductions we're going to go over is the blind or disabled deduction. This allows for deduction with a fixed amount of $12,480 from assessed value if the taxpayer is blind or has a disability. Now, those are specifically defined in statute. We'll go over that in the next slide. But also the property the taxpayer is claiming the deduction for is being used as a principal place of residence, kind of like with the homestead deduction. But here it's going to be used as the taxpayer's residence. The taxpayer must also not have an annual income that's greater than $17,000 or less, on the condition that it does not, you're not counting income that is not being taxed under federal income tax laws. So annual income of $17,000 or less, but not including what isn't being counted under the Internal Revenue Code. And the taxpayer must also own or buy the property or be buying the property on contract on the date of applying. Next. So when we're talking about what is defined as blindness or disability for purposes of this deduction, for blindness, it refers to a statute, a definition for blindness under Title 12. this slide has a citation for your reference. The DLGF, we aren't involved in social services or family services, which is typically what Title 12 is for. And we're certainly not experts, I don't claim to be, at least in optometry. But blindness is generally defined under that statute as having vision with correcting lenses of 20/200 or less, or having a disqualifying visual field defect determined from an eye exam. Likewise, disability is defined actually in the deduction statute itself, unlike with blindness, as having in the deduction statute itself as being unable to engage in any substantial gainful activity because of physical or mental impairment, which can be expected to result in death, or which has lasted or can be expected to last more than 12 months. Now, what's important here, next slide, is the proof, which has to be provided when the taxpayer applies for the deduction. Disability has to be proven either by showing eligibility to receive disability benefits under the Federal Social Security Act, or examination by a physician on using the same standards as the Social Security Administration. Now, blindness is proven either by the records of FSSA, Family and Social Services Administration, the state agency, or a written statement from an eye doctor after an examination, and the eye doctor has to be licensed in Indiana. Next slide. So I'll go into covering the over 65 deduction and the circuit breaker. The over 65 deduction is available to taxpayers who are obviously 65 years of age or older by December 31st of the year before the year the deduction is claimed. So say a taxpayer wants to claim the deduction for pay 25, they have to be 65 years old as of December 31st of 2024. There are some limitations to being eligible, kind of like with the over 65 deduction. First, with this one, with the blind and disabled deduction. First, with the over 65 deduction, there's an income threshold that is based on whether there's joint ownership on the property, or the income tax, how the taxpayer reports the income tax return. You can see the threshold limits here. One thing I'll note is that recently the legislature did amend this law so that the annual income limit is adjusted by the cost of living adjustment for Social Security benefits, as stated by the Social Security Administration. The DLGF has an annual memo that is linked to in this slide that that just reiterates what that cost of living adjustment is for purposes of this income limitation for this deduction. The second limitation has to do with assessed value. Claiming the over 65 deduction, the assessed value cannot be, for the property, cannot be more than $240,000. However, after the deduction is first applied on the property, any increases in assessed value, especially those increases that bring the AV over that limit, the only increases that would count are those due to substantial renovation, new additions, or improvements on the property. You are not to include any increases in AV that are attributed only to trending or annual adjustments. The last limitation on this slide, at least, is the taxpayer may not receive any other deduction except the homestead standard, the supplemental, and these fertilizer storage deductions. Next slide. So surviving spouse of a taxpayer is also entitled to the deduction, even if the spouse is themselves not at least 65 years old, under certain following conditions. First, the surviving spouse is at least 60 years old or older by December 31st of the year before the deduction is claimed. The surviving spouse's deceased husband or wife was at least 65 years old at the time of death. The surviving spouse has not remarried and also meets all of the qualifications for the over 65 deduction except of age. But again, the spouse has to be at least 60 years old. This is kind of meant to allow surviving spouses of a deceased individual who would have otherwise qualified for the deduction to get the deduction, even if the spouse is not themselves over 65. Next. So while state law does not require that the individual claiming the deduction has to use the property as a principal place of residence, the law does provide that the property, that the deduction would not be denied if the individual is absent from the property because they're in a nursing home or a hospital. And also, if there are any co-owners to the property, this is another limitation to bring up. Only one limitation may be, only one deduction may be allowed. However, only one of the co-owners needs to be at least 65 years of age. The effect of this, however, is that if there are co-owners and not all of them are over 65, there is going to be an adjustment on the amount of the deduction that's available, as the next slide we'll get into. So the amount of the deduction is fixed at $14,000, subject to that mobile home adjustment. The exception, though, is when if you have co-owners who are not over 65, like I mentioned, the amount is reduced proportionally by the number of co-owners who are not 65. And state law actually identifies or actually spells out how this proportion is to be, how you're supposed to, how the proportion is set. So the numerator, this is a fraction, you multiply the initial deduction amount by a fraction, and the numerator is the number of co-owners who are under 65, and the denominator is the total number of co-owners. And when you make that fraction, you multiply that by the initial deduction amount, and what results is the adjusted amount. As to the next slide, as it shows an example, say you have 3 co-owners on the property, but only one of the co-owners is over 65 and otherwise qualifies for the deduction. The proportion of those under 65 is 2 out of 3. So that's a 67% of the co-owners who are not over 65. By law, the amount of the deduction has to be reduced by 2/3. So you end up with a qualifying deduction amount of $4,667. Next. And yeah, like I said, this deduction amount is subject to also the limitation on mobile homes. Next. Now the over 65 circuit breaker is related but different. The qualifications will largely mirror the deduction. However, there are no conditions regarding co-ownership, including the amount adjustment. Also, the applicant must also have qualified for the homestead deduction on the property, or as a surviving spouse of someone who qualified for it for the last 2 years. And a taxpayer who applies for the over 65 deduction must also apply separately for the over 65 circuit breaker. In other words, it's not automatic. If you get one, you can't automatically get the other. You have to apply for them. The state form, I believe, application form for the deduction you have to check both boxes. So getting one doesn't mean you automatically get the other. So the way the circuit breaker credit works is essentially it caps the property tax liability to 102% of the prior year's liability. It's meant to limit the growth of the property taxes on a qualified individual to 2% of the prior year. As the next slide will illustrate, say you have a taxpayer's liability in pay 24 was $1,000. The next year, without the circuit breaker, let's say the taxes would be $1,100. So it would be a $100 increase. With the circuit breaker, however, because it's capped, it caps the increase at 2%. The circuit breaker would kick in and cap the liability for the pay 25 tax bill to $1,020. So it caps it at the liability at 2%, or the increase at 2%. Effectively, it operates by a credit, so you're taking the pay 25 tax liability without the circuit breaker, which is 1,100, subtracting 80 from that, which is the amount of credit the government is giving back to the taxpayers. So the liability for pay 25 with the over 65 circuit breaker is $1,020. Next. So with the veterans deductions, and there are several of them, the two most common ones, they kind of go under different names, just as a shorthand. One way to think about them, the first one is a veteran with a service-connected disability. This is sometimes called the partially disabled veterans deduction. The other one is what's commonly called the totally disabled veteran, or veteran. Also refers to veterans with at least 62, who are at least 62 years old with a partial disability. Sometimes it's also called the non-service connected deduction. There's also one available for homesteads that have been donated to a disabled veteran, and then one that is technically still on the books. I'm not sure if anyone in Indiana still qualifies for this, but for surviving spouses of a World War I veteran. And separate from property taxes, but it is related to the veterans deduction, as an excise credit available for those when they would qualify for the deduction, but under some circumstances can't be applied to a property. Next. So the partially disabled / service connected disability deduction, again, I'm using shorthands here. Please refer to the statute for the specific qualifications. For the most part, what we're talking about here is taxpayer to qualify has to have served in the United States military during any of its wars. Wars of the United States, was honorably discharged and received a service-connected disability, hence the name, of 10% or more, hence the other name, as evidenced by certain documents of the U.S. Department of Veterans Affairs or of the Indiana Department of Veterans Affairs. The amount is fixed at $24,960, again, subject to that mobile home adjustment. Next. Similarly, with the totally disabled or veteran of at least 62 with a partial disability, the taxpayer must have served in the U.S. military for at least 90 days. Note that does not necessarily mean they had to have served in any of the wars of the United States. They just had to have served in the U.S. military for at least 90 days and also have been honorably discharged and received either a total disability or is a veteran of at least 62 years old with at least a 10% disability, again, evidenced by documents of the U.S. or Indiana Department of Veterans Affairs. Please note, under law, in this case, unlike the other deduction, which allowed evidence shown to be including a compensation check by the U.S. DVA, this deduction, the law does not include that specific document as evidence, but the other ones are still included. This one has the amount of this deduction is $14,000, again, subject to that mobile home adjustment. Next. So with this totally disabled / non-service connected disability, yes, there's also a assessed value limitation, just like with the over 65. And again, it's not more than $240,000. But like with the over 65, it does not include any increases in AV due to trending unless it's attributed to some substantial renovation or new improvements on the property. And the county assessor must inform the county auditor of any such improvements or renovations on the property. Next. So it is possible for a taxpayer to receive both of these deductions, provided that the taxpayer meets the qualifications for each one. So you would simply just combine the deduction amounts for each of them to result $38,960 for both deductions. Next. a surviving spouse, like with the over 65, a surviving spouse is eligible to receive both of these deductions, provided that A, the deceased veteran must have met the disability requirements at the time of death. The surviving spouse must own or be buying the property under contract at the time of application. But also with the totally disabled deduction, the deceased veteran must also have been killed in action or died either while on active duty or during inactive duty training. So that's an additional qualification that needs to be met with the totally disabled deduction. Next. I mentioned this before. It's technically still on the books. It's not sure if any current taxpayer in Indiana qualifies for this, but it's technically still on the books for this surviving spouse whose deceased husband or wife husband had served in the U.S. military before the end of World War I and has received an honorable discharge. And the surviving spouse had to have owned or buy the property under contract on the date the application has been filed. The limitation here is that the surviving spouse may not also receive the partially disabled veterans deduction. Another point I do want to bring up too is that with surviving spouses, they themselves can't have their own veterans deduction, even if they are also receiving the veterans deduction by virtue of their deceased spouse. So it is possible to kind of have two veterans deductions for a surviving spouse who also has their own deduction for the veterans. Next. Okay, so in this one, we have a deduction for a homestead who has been that has been donated to a veteran. In this case, a nonprofit organization would donate a home to a veteran. And if the veteran is 50% or more disabled and he or she receives the corresponding deduction from the AV based on the level of disability. So if the veteran is like 50% disabled, the amount of the deduction is 50% off the AV, 60%, it would be 60% off the AV. And if the veteran is totally disabled, it would be 100% of the AV. So it's just proportionate, or there's a direct correlation to the amount by the level amount of the deduction and the amount of disability. The veteran must have served in the military for at least 90 days and have been dishonorably discharged. And the disability does not need to be service connected, and it can be evidenced by the same documents for the as for the totally disabled deduction. However, in this case, you cannot also receive either the partially disabled or totally disabled veterans deduction. Next. Now, the state law also provides for a special credit off of excise taxes under circumstances where a taxpayer can qualify for the veterans deduction, but there's some for a couple for special situations, the veterans deduction cannot be applied against property. So as Emily mentioned in an earlier slide, if the veterans deduction is applied after all of the other available deductions have been such that there's still the assessed value of the taxpayer's property has been zeroed out and there's still veterans deduction left unapplied, that balance can be used as a credit against the taxpayer's excise taxes. The credit is $2 for each $100 of assessed value left in the deduction balance. And this is, it says this is for partially disabled and totally disabled, and I went back and verified it's also available for surviving spouses of World War I veterans as well. But like I said, for the most part, we're only talking about the partially disabled and totally disabled deduction recipients. Next slide. Now, in another circumstance where an excise credit can be obtained is if the taxpayer does not own property to which a veteran's deduction can be applied. One instance where this could occur is if the taxpayer owns real estate, but for whatever reason, like the taxpayer's the assessed value limit or the assessed value of the property goes over that assessed value limit, especially for the totally disabled deduction, that could qualify the taxpayer for an excise credit of not to exceed $70 and cannot be on more than 2 vehicles that the taxpayer owns. And this credit cannot be claimed along with the credit from the application of the remaining balance of the veterans deductions that I mentioned in the previous slide. Next. Oh, I guess I'll turn it back over to Emily to go over homestead deductions.
Thank you, Dave. We're going to go ahead and dive into the homestead deductions. Now, it's generally going to talk about the standard homestead deduction and supplemental, but before we dive into that, kind of want to set the table a little bit with a change in the overall value for the homestead deduction. And it was based on the more recent repeal of the mortgage deduction. During the 2022 legislative session, the General Assembly passed House Enrolled Act 1260, which repealed the mortgage deduction. In addition to repealing the deduction, they also took the value under the old mortgage deduction, which was at maximum a $3,000 deduction amount that could have been claimed, and they added that amount to the amount that could be deducted from the valuation under a homestead deduction. So the mortgage deduction is gone, but we still get to have some of its benefits in the amount for the homestead deduction. So looking at the homestead deduction in general, there were some modifications during the 2023 legislative session that further flushed out what it means to have a homestead, or what homestead is defined to include. Previously in statute and in the current version of code, they both say that the homestead is an individual's dwelling that's used as a principal place of residence in the immediately surrounding space not to exceed 1 acre. Dwelling has always further been defined to include a more detailed breakdown of that. And so in addition to it being the individual's residence, there was the further clarification in code that it also includes a garage, whether it is attached or detached. That was clarification that wasn't previously in code, but now it talks about a dwelling being the place where they live and 1 garage. It has to be located in Indiana, and it can include investment or rental property. Principal place of residence has been defined under the Department's Administrative Rule 50 IAC 2425 to include a true, fixed, and permanent home in which the individual intends to return after an absence. I know in an earlier slide there was reference in the over 65 deduction to somebody who was, in a nursing facility, and that status of being in service of medical care did not disqualify them from the deduction. In this case, that also applies for the homestead deduction. If there is an intent from the individual that owns the property to return to the home at some point in the future, it would be considered their principal place of residence. And again, the individual who is wanting to claim the homestead deduction, they have to own the property or be buying it under recorded contract or recorded memorandum, or occupy the property as a trust that is seeking a deduction in conformity with the Indiana Code 6-1.1-12-17.9. I think we'll cover that one a little bit more in a later section of the presentation. So in addition to kind of clarifying some language around what it is to be a dwelling, there were also additional clarification points or additional items listed as what is considered to be part of the homestead. So again, homestead property may include the dwelling, which we talked about in the previous slide, up to 1 acre of land immediately surrounding the dwelling. In that case, the immediately surrounding was a qualifier that was added during the 2023 session. So those pieces weren't entirely new, just a few additional clarifications that were added. But in addition to that, they specified in the 23 legislation that any number of decks, patios, gazebos, and pools are considered to be a part of the homestead. 1 additional residential yard structure that is not a deck, patio, gazebo, or pool, as well as 1 additional building that is not part of the dwelling if the building is predominantly used for a residential purpose and is not being used as an investment property or as a rental property. In addition to having additional structures or types that were considered to be part of the homestead, there is the distinction in the language of the code as it currently reads that these additional structures, the yard structures, the decks, the patios, gazebos, pools, or additional building, do not have to be included or be located within the 1 acre of land that is immediately surrounding the dwelling. They can be anywhere on the parcel as long as they meet the qualifications as they are defined in statute. So the amount of the deduction, like I mentioned on an earlier slide, had been increased. prior to the repeal of the mortgage deduction. It was the lesser of 60% of the gross assessed value of the property, or $45,000. Now it is the lesser of 60,000 of the gross assessed value of property, or $48,000. Similar to some of the other deductions we've looked at for mobile and manufactured homes, the deduction amount is limited to half of the value of the property. So as we look at the homestead deduction for purposes of married couples, there are many times where we'll get questions that come in of individuals that are still technically married, but they are legally separated, they're living in separate residences, and how does that impact either spouse's ability to claim the homestead deduction? So only one individual by default, or of a married couple, can receive the homestead deduction for a particular year, and there are only a few exceptions to that rule. And so the first exception that we'll see is, moving residences, and this in some ways applies to more than just married couples, but the statute that's referenced here, the 61.1-12-37, incorporates a language that we refer to as the one-year carryover provision, and it applies to most deductions, but the limitation specifying that an individual or married couple can have more than one homestead deduction doesn't apply to property in the first year for which the homestead deduction is claimed. The sole reason that they might have a deduction tied to them is because they are locating or relocating to another property. So if you're moving and you have a homestead deduction on the property that you just sold, and you want to claim a homestead deduction on the property that you've just purchased and are moving to, there is the ability for a carryover, so there's not an inadvertent loss of the benefit of the deduction just because you have relocated or bought a new property. We'll go over in a little bit the best way to reflect that or file for that on the sales disclosure form. But it's important to note that the secondary property doesn't have to necessarily be a newly purchased property to apply. It's the most common that we see, but sometimes if you happen to own two properties, you're holding one as a rental property and one as your personal residence, and you decide you want to live in the rental property and you want to now rent out what was your residence, the same carryover would apply for that situation as well. The second exception that we'll see with the homestead deduction is for spouses that reside in different states. If an individual, they are still legally married, but for one reason or another, they are living separately in different states, and they meet any of all of the qualifications listed here, it's possible that they can still receive the homestead deduction if the spouse is receiving a homestead deduction on another property in another state. And that qualification is that they have to maintain a separate principal place of residence. Neither individual has ownership interest in the other person's principal place of residence, and neither individual has claimed a homestead deduction that year for any property other than the one that is being maintained as their principal place of residence. Now, to collect the information to kind of verify that these prongs of the statutory test are met, the county auditor would prescribe an affidavit that would be submitted by the individuals, providing the necessary information to show that they maintain a separate residence, they don't have any ownership in those residences, and that they're not claiming a homestead on another property at the time. Aside from those, and so situations where you might still be legally married, but spouses are separated and living in different counties or even within different places within the same county, unfortunately, the exception wouldn't apply. If they're separated, but they're still legally married, they can only have one homestead deduction between the two of them. Now, before we go into the slide about the 1 acre rule, I would preface that the department, is aware of an appeal and a decision that was recently issued by the Indiana Tax Court from a case that came out of Lake County, and it related to a review of constitutionality of the 1 acre provision in the homestead deduction statute, and whether or not the 1 acre kind of limitation for where the homestead deduction and the corresponding 1% property tax cap would apply. It was determined in that case that it was unconstitutional as applied to the specific facts of that case, but there is still the opportunity for appealing that determination to the Indiana Supreme Court, and if it's not appealed or the appeal is unsuccessful, there has still been the remand to the Indiana Board of Tax Review, and so there are still additional moving parts for that, and so things may change, but this slide does reflect what the statute currently reads. We would just encourage everybody to just keep an eye out on how things move through the court system and whether or not there are any changes to the statute that follow that. But as it currently reads, the 1 acre surrounding the dwelling can overlap with multiple parcels, and it should not preclude the taxpayer from receiving a complete deduction under that 1 acre. The property where the homestead's located, it can be vacant. Sometimes, whether an individual, it's their principal place of residence, but they have to relocate for a not insignificant amount of time due to habitability issues and repairs, or a new home is being built for them and it's only partially completed, there's still the possibility under the homestead deduction statute for them to be able to apply and qualify for the homestead deduction. They also have a provision that speaks to whether an individual or it's either a single person or a spouse of a married couple that is located overseas in active duty, and the ability to transfer and to not have the removal of a homestead deduction because they are currently out of the country, or how they apply for that, or even how to notify them of any changes in the deduction status while they are serving overseas. Next is homestead deductions and LLCs, or just business entities. So during the 2023 session, under Senate Enrolled Act 325, there was the repeal or the removal of provisions that had been in code that allowed for an individual who has a principal place of residence, and the residence is owned by a business entity or partnership or LLC. If that individual is also a shareholder, a partner, or member of that business entity, and the property at issue was eligible for the deduction as of May 1st of 2009, they could get the homestead. That was removed in the 23 session, but was reinserted back in the code during the 2024 legislative session. With the effective dates of both the 23 legislation and the 24 legislation, there should not be any gap in the language still being in law, and so it should have no impact on property owners that would have otherwise qualified under those provisions of code during the sessions previous to the 2023 session. So it's just kind of a clarification point. So status quo for the most part on this area for business entities that are claiming a homestead. Now, looking for proof of eligibility, the auditor can require an individual to produce evidence showing that it is, in fact, the individual's principal place of residence. Statute outlines a couple different examples of documentation that can be requested and collected by the county, but it's not meant to be an exhaustive list. And sometimes it's not practical to get these kind of document materials to prove a place of residence. But it does reference the state income tax return, a valid driver's license, or a valid voter registration card. However, we know in practicality that state income tax returns are going to be reflecting a previous year. A valid driver's license, you have upwards of 60 days to get a new license with your current address, and registration card for voter registration cards are not as frequently issued as they had been in previous years. So sometimes what statute contemplates is not going to be the whole universe of what could be collected from the county. We just encourage any county auditor's office that wants to request additional document types to, one, consistently collect those from all individuals that are applying, and two, make it known to taxpayers what's going to be expected when they're applying, so that they know that what to provide you right from the get-go, so that it makes for an easier administration process. We would note, too, that any dispute over the eligibility of a homestead deduction in 1 year doesn't necessarily justify or mean that the county needs to request the same documents each year to ensure that eligibility continues. Likewise, the auditor should not tell taxpayers that they will not accept the application for the homestead deduction if they don't provide a copy of their Social Security card or tax return. They can provide a portion of the tax return, they can show it to you to not keep on hand. And for the Social Security card piece, we'll get into that a little bit later as to why you shouldn't expect or ask them to provide a copy of that card. But if in reviewing of the application, there is legitimate need for supporting documentation, there are additional criteria that can be, added to taxpayers, because again, the statute gives a list of examples, but it is not meant to be an exhaustive list. For the supplemental homestead deduction, we'll just go over that quickly. This is one that kind of goes in tandem to the homestead deduction, but instead of being a flat amount of $48,000, the supplemental homestead deduction is going to be based on a percentage of net AV for property types. Two amounts that are listed here, the 37.5 and 27.5, were a part of a 2-year kind of increase or graduated percentage that the supplemental homestead deduction would be based on. And it will be returning to what had previously been the standard of 35 and 25% after the 2025 tax year. And so for the 37.5 or 35%, it applies to properties that have an overall value that is less than 600,000, and the 27.5 and 25% applies to properties that have a value that is greater than 600,000. So to claim either the homestead deduction or the supplemental homestead deduction, both would be claimed on the form, which is commonly referred to just as the homestead deduction application, or HT10. They can be found on the agency's website at that link on the screen. Also, the sales disclosure form. We referenced this earlier. There's a section, there's a portion under section J of that allows an individual to claim a homestead deduction, as well as a handful of other environmental deductions we'll cover in a few slides. It also references if you are currently receiving one at the property that you are moving from or selling, and if you would like to apply for the homestead deduction on the one you have purchased and are moving to. A property has to be receiving a homestead deduction in order to be considered under the 1% property tax cap. So this is the slide I referenced earlier about the Social Security numbers as a part of what has to be included on the application for that deduction. Statute specifies that it's not the entirety of the Social Security number that is required, but the last 5 digits. And if an individual does not have a Social Security number, they are able to provide a state identification number or a government issued identification number. The purpose of the inclusion of the last 5 digits of a Social Security number or a government issued number is to be able to use those data points in the homestead deduction database. And this is the tool that counties use to ensure that individuals are not receiving a homestead deduction in more than one county. So with change of use, similar to other deductions or even property exemptions, if there's a change in the use or it's no longer someone's principal place of residence, or they're planning to receive another deduction in another state, the obligation is on the taxpayer to notify the county of the change in use or the claiming of another deduction. Failure to notify the county may result in the taxpayer having additional taxes or penalties for improperly receiving the homestead deduction. Statute on the screen kind of further details that the county auditor has the ability to kind of do a 3-year look back to see if a deduction has been improperly claimed and received for a 3-year period, and the penalties and interest that can apply to an individual that shouldn't have received a homestead deduction but has been receiving it. There is kind of one exception that an individual who is like a bona fide purchaser at an arm's length transaction that didn't know that there had been a homestead, it wasn't a part of the documentation they received, they shouldn't be penalized for, any additional taxes or penalties that result from removal of the deduction, as they weren't the ones that owned the property potentially in those previous 3-year look back period that had the deduction. So they shouldn't be penalized for something that might have been on a property over time when they didn't own it. So again, if the auditor decides to seek penalties for this, they have to issue a notice of the taxes and interest and the penalties due to the owner that improperly received the deduction. And it has to be somebody that had owned it and still owns it. Again, if they were a new purchaser, they shouldn't have penalties applied. And now I'm going to turn it back over to Dave to go over a few other.
Okay. So just briefly going over property that is owned by a trust under Indiana law. A trust can be eligible for a deduction for the deductions listed here. As you saw in a previous slide, this also factors into whether a certain property owned by a trust is eligible for a homestead deduction. Next. The property must be occupied by an individual who, upon verification in the body of the deed or otherwise, has either a beneficial interest in the trust or the right to occupy the real property rent-free under the terms of a qualified personal residence trust created by the individual under U.S. Treasury Regulation 25.2702-5C2. And the individual must also, or the property must also otherwise qualify for the deduction being claimed. So those are the two main factors for when a trust can receive certain deductions. So we'll move on next to talking about the heritage barn deduction. This is for a specific type of property, and the qualifications depend largely on definitions spelled out in statute. First, statute defines what a barn is for purposes of this deduction. It refers to a building other than a dwelling that is essentially it's being used as a barn, or was designed to be used as a barn. It houses animals, crops, agricultural equipment, or just otherwise used for activities, agricultural activities conducted on adjacent land. Next. So with the definition of a barn, next question is, what is a heritage barn? The law defines a heritage barn as a mortise and tenon barn. The next slide will define what mortise and tenon means here. That on the assessment date was constructed before 1950 and retains sufficient integrity of design, materials, and construction to clearly identify the building as a barn. And these are two key considerations. First, is the building a barn? And then second, was it constructed before 1950? And does it retain sufficient integrity of design, materials, construction to clearly identify the building as a barn? This is one of the deductions where there's some pretty interesting fact patterns about whether a barn that has been, for example, disassembled, relocated, and then reassembled, well, was that constructed before 1950 or constructed after because it was just disassembled and then put back together somewhere else? Or was, over time, since these are fairly old, over the years, you'll have to, the owner or previous owners would have had to replace planks of wood, some of the mortise and tenon joinery over time. Would the barn no longer have any of the original pieces of wood being used, kind of like a ship of Theseus problem, or I guess in this case, a barn of Theseus problem, such that none of the original components of the barn used before 1950 to build it are there anymore. It's fairly interesting fact patterns here that have to be considered. But going into what is the mortise and tenon joinery, we're talking about a barn that was built using heavy wooden timbers joined together with wood pegged mortise and tenon joinery that form an exposed structural frame. So we're not talking metal fasteners, we're not talking nails, screws, staples, things of that sort, which gets into another interesting scenario where we're seeing these barns that could be used for not for dwelling, because again, you cannot use this as a dwelling to qualify, but as event centers, recreational spaces that may require some renovations to the property using modern construction techniques such as metal fasteners, not really using mortise and tenon joinery. So that does kind of factor into whether these sorts of properties could qualify for this deduction. Next. So an eligible applicant, much like with the other deductions, they have to own the barn or be purchasing it under a contract. Next slide. The amount of the deduction is equal to 100% of the AV of the structure and foundation of the barn. The application to apply must be filed during the year preceding the year in which the deduction will first be applied. And then the deduction, once applied, it terminates following a change in ownership of the barn. However, the deduction does not terminate if you have a joint ownership or joint purchase of the property where the barn is located, and all but one, at least you have to have at least one of the owners or purchasers still own or be purchasing the property under contract. So if some of the other joint owners or purchasers bail out of their interest in the property, as long as you have that one who still retains an interest in the property, the deduction survives. Next. The county under state law, also has the option to impose a fee. It's called a public safety fee not to exceed $50 on owners who are receiving this deduction for the Heritage Barn. The use of the fee is for police and fire departments where they have jurisdiction over the area in which the Heritage Barn is located, and the auditor has to distribute the revenue from the public safety fees equitably among police and fire departments who serve that area. Next slide. And this is just providing the link to the Heritage Barn deduction application. Next. And I'll go ahead and turn it back over to Emily to go over environmental deductions the time we have remaining.
Yes, thank you, Dave. I'll try to go over these relatively quickly. I know we're reaching the end of our hour. There are several different environmental deduction types. Some of them can, based on the equipment or piece of property that you're looking at, could potentially fall into very different buckets, different statutes, but they could have very similar features. So it's going to be important to take a look at the statutes we have listed on the slide, see which one the individual taxpayer is claiming on the application, as all of the environmental deductions are claimed on the same application, but it will matter as which one they are pursuing because a few of them have a couple of different steps that may not be available to at least the solar powered device deduction. So in order to claim the environmental deductions, you would have the individual taxpayers fill out the form that is listed on the slide. All of them are there. They would just select the box on the form as to which one they're pursuing, and this form, once it's completed, has to be filed in duplicate with the county auditor's office. As I referenced earlier, there are a couple of the environmental deductions, majority of them actually, that can be claimed on the sales disclosure form. However, it does not include the solar power device deduction. That has to be claimed on the form itself and cannot be claimed on the sales disclosure. So the filings for any of the deductions, environmental deductions, have to be filed with the county auditor by January 15th of the calendar year in which the property taxes are first due and payable. This is a change for pretty much all of the deductions except for the Heritage Barn deduction, where it used to say that they had to be completed and dated by the end of the year preceding when they would receive the deduction, so December 31st, and then be received by the county by January 5th of the calendar year that the taxes are first due and payable. Now it's been simplified in statute for, again, all but the Heritage Barn deduction that they just must be filed by January 15th. So for the hydroelectrical system device or geothermal device, they have to be accompanied the applications with a certification from IDEM as to the status of the property that they are claiming the deduction for. So application filings for the solar power device, again, is slightly different from the other ones in the sense that there is also a Form 103 SPD that would include personal property or an amended personal property return based on that specific environmental property type. So general qualifications for all of them is that on the date the application is filed, the applicant must own or be buying under contract the property that they are seeking a deduction. And then real property or mobile home that is not assessed as real property that's equipped with any of the listed types here. They have to actually have them on site in order to apply for them. And a person who is receiving the deduction a particular year for the listed ones on the slide here remain eligible for that deduction the following year, and they're not required to refile that deduction the following year. However, for the solar powered device, they do have to refile that on an annual basis, including some of the state distributable forms, which is that 103 SPD. Now, the amount for the deduction is largely either based on the amount that equals the out-of-pocket expenses for the components and the labor to install the property, or it's going to be the maximum amount of the property overall minus the value of the property that was installed, or it's just going to be the outright value of the actual device or property that was installed. So they look generally at the same thing, just from very different lenses for the listing breakdowns that we have in the slide here. So it'll be important to know what the property type is and what lens you have to look at for determining value. And I think that's all we have today. I know that we were a little short on time. We ran over by 3 minutes. We apologize for that. We thank you all for sticking with us, and I will turn it back over to Jenny.
Well, thank you, Emily and Dave, for our informative webinar today on deductions. Just as a reminder, please feel free to reach out to any of our attorneys there. Emily's provided their contact information. You could also reach out to our support email and we'll get you connected with our attorneys to get those questions answered. And we had a few questions that came in today during the webinar. We will combine those with this morning's questions and we will put together an FAQ and post that on the website. Once that is available, probably give us at least a week to get those answered, and we'll get that posted as soon as it's available. Later this week, you will get an email that will, if you pre-registered, it will also be on the DLGF webinars webpage. You will get an email that will have the PowerPoint, the video link, as well as the CE form and the survey form. Again, this is valid for 1 hour of CE credit. You do need to self-report that. If you are an assessor, you need to fill out the CE form and submit that to education@dlgf.in.gov. It is a new email address that we have here in our office to help manage all of our CE submissions that we have come in. If you are an attorney, we need you to complete the survey and put in your attorney number in that field. That is the last field on the survey. If you're not an attorney, you can leave it blank. But we do appreciate all the feedback that we get from the surveys. That helps us as we start to plan for future webinars. We do have, we will start to plan for next year's here in the next couple of months. So if there's any hot topics that you would like us to address at upcoming webinars, we do appreciate that feedback. So please just check out that email when we send that out. You can also share that with other individuals within your office. They can still get the CE credit if they watch the video and submit the CE form. We will be having a webinar in September, and we have our assessment division. It's going to be covering nonprofit assessments. So we hope that you'll be able to join us for that one. That's going to be on September 18th, and Barry's going to give our presentation on that. So thank you all. We'll leave the chat box open in case there's any other questions for a few more minutes, but you can all have a great afternoon and a great weekend, and we will get those questions posted as soon as possible. Thank you.